Hello, welcome back to this series of instructional videos on the Intopia simulation. What I have here that I'm going to demonstrate at this particular time is the projections workbook. And this is something that teams can use at the beginning of the game once they've gone through the practice decisions to make projections in terms of how much money they think they're going to need to proceed throughout the game. And it may be used to supplement your initial public offering if that's one of the assignments that you've been given to do. Okay, so what this does is it walks you through a step-by-step process of preparing financial projections. Okay, and you can see at the beginning here on the worksheet that it asks you to begin by entering how much starting capital you think you will need to proceed. Now, no, we can change this later, but I'm going to put in 50 million here, just for fun, because I think that seems to be about how much I'm going to do. And then the next thing that we do is decide how we're going to proceed with plant construction. So what I'm going to do is go over to step 1, plants. And at this point in time, you're going to need to know what your strategy is. So I'm going to assume that I'm just an X producer at this particular time. And so all I'm going to do is build an X plant and produce some X and sell that to consumers and to other businesses. Okay, so this is a fairly straightforward strategy. So let's say that the cost of one X plant is $10 million. So I'm going to enter that into the cells here, okay? And I'm going to do that in period 1, and then I'm probably going to open another one in period 4, okay? So I've got, oops, I got too many zeros there. So I got 2 plants that I'm going to proceed, and I'm going to focus only in on North America at this particular point in time. So the next step, now that I've got my plant set, is to go on to the production schedule. And that's what this looks like here. So we've got a couple of different things that we can do here. We can produce or we can source. Okay? So the difference is on this side, we are doing our own production. And on this side over here, we're sourcing. In other words, we're buying from other teams. Well, we're not going to do that in this particular case. We're going to produce. And we know we can only produce in period 2 because our plant has been built in period 1. So let's say we're going to produce 50,000 units in our first plant. And we think the variable costs of those are going to be around 40 bucks. Okay? And we're going to do the same thing in period 3. Oops. And the same thing in period 4. Now we know in period 5 we're going to have an extra plant because we built another one in period 4. So we're going to up our production to 100,000 units. And that's $40. Okay, so that's all we're doing. We don't have to worry about sourcing because we're not going to buy from anybody. And we don't have to worry about Y production because we're not doing that just yet. Okay, so let's go over to sales projections of X now. And you can see we've carried over here that we have some goods available for sale in period 3. This is carried over from our production. Remember, we produced that in period 2. And so we're going to estimate some sales. So let's say we're going to sell 20,000 of those units to consumers at a price of $80 each. And we're going to sell the other 30,000 units to another team at $65 each. And you can see that the goods available for sale are automatically updated. Let's say we up our price a little bit in each period. And then we still have some more available for sale here. We can assume that we're selling maybe an extra or a different grade here. And we assume that we're selling all of the inventory that we're producing. Okay, so those are our sales projections for X. If we were selling Y, we would have a similar projection sheet. Okay, with X, there's also this area called component sales. And that's where you would reflect whether or not you are selling X to your own Y plants or not. So if we were producing X and also producing Y, we may reflect some of that in component sales. Okay, so we're not selling any Y, so we're going to go on now and estimate our marketing costs. So we have consumer sales, and we know that those are going to have a unit cost per sale. So let's say that it costs us $1 per unit to sell X to consumers, and it costs us $2 per unit to ship them to other companies. So what that does is give us some marketing expenses there. Sales office costs, those are in dollars. So let's say it costs us $10,000 to operate a sales office every period. And then we're going to spend $500,000 on advertising to support our consumer sales. Those are our marketing costs, and we have nothing else. We can estimate our other expenses. Let's say we're going to do some R&D of $500,000 each period. So very consistent R&D expenses throughout all the periods. Oops. And we're going to do some methods improvement once our plants are open of $50,000 each period. And then a little bit more in period 5 because we have 2 plants. And then we can just do estimate some other expenses for market research. Again, we can vary these as we see fit. Let's just put in an estimate of, remember these are projections, so we're just getting an idea of how much we're going to be spending on market research, insurance, professional fees, that sort of thing. Step 6 is other income. We may decide that, in this case it's SIM cards and smartphones, we might decide that we get a little bit of licensing income from the R&D that we did, if that's our strategy, but not much else. Okay, you could put in interest income or miscellaneous income. Step 7 are other financing issues. Are we going to get other loans or send out loans? But we don't have any of those to look at just yet. And in step 8, we're going to estimate our taxes. Well, we're not making any money yet, so no sense putting any taxes in there. And then, but if we were, we could put in some other rates, or we could estimate our income tax as we go along. And here we can enter in any assumptions that we have. Okay, so one of our assumptions is that all of our inventory is sold each period. Okay, and that minimal advertising is required of $500,000 per period. Okay, that might actually be a little too much for this. Now you can see that after we've done these projections, our balance sheet is automatically generated for each period. And you can see we've got lots of cash available. So our certainly the amount that we asked for in terms of $50 million in common stock is certainly enough. Our income statement is automatically generated. And you can see that we have a positive margin from sales each period. Depreciation and fixed is generated each period. You can see we have the commercial and admin expenses are carried through from the marketing costs that we've done, the advertising, etc. And you can see how we have a net loss each period of a certain amount of money. So this would be a little bit of a concern if these were in fact our projections. Okay, that we're not making any money at this particular point in time. If we look at cash flow, which is the last sheet, we can see that this is broken into sources of cash and uses of cash. And you can see that certainly this particular strategy, starting out with $50 million, is certainly sufficient. By the end of period 5, we're down to $24 million in available cash. So we're still floating, but we're not profitable at this particular stage. Okay, so that's a fairly straightforward projections using a very easy strategy of just producing X. Now, of course, it gets a lot more complicated if you decide that you're going to produce Y at the same time, because then we would also have to build a Y plant. So let's say that that is also $10 million. And then our production schedule, of course, would be different, because we wouldn't be able to produce Y until period 3, because that's when the Y plant, in fact, you wouldn't even need to build the Y plant until period 2, because you need some X in order for that to be useful. So in period 3, we could begin producing Y. So let's say we're going to produce 20,000 units of Y. And the variable cost of that is going to include both components and the incremental costs. So we know the component costs are going to be about 40 bucks, right? So let's put that in there. And let's say the additional cost, excluding the components on top of that, is another $40. Okay, so we can just estimate that as follows, and we can carry that on through for each period. So this is where it gets a little bit more complicated when you're doing both X and Y production, is because you're using some of those units. So we're going to have to take 20,000 of these units and use them as components, right? So, and our component transfer price, we'll just keep it at the price that it was here. And now we're going to have to reduce our B2B sales to 10,000 so that we have enough left. Okay, so we'll see now that our 50,000 units of X are now going 20,000 to consumer sales, 20,000 to be used in the production of Y, and 10,000 to be used in B2B sales. Okay, and now we have some Y available for sale. So we can sell this 20,000 units, say to, or let's do it again, we can do 10,000 to the consumer. At a consumer price of, let's call it $300, and we can do 10,000 to a B2B firm at $250. And you can see that that the inventory is adjusted accordingly. Okay, so that we have sold additional units of our Y units. So the process is the same then. You'd have to go through marketing costs and estimate the shipping costs per unit. And I'm just going to do that very quickly here. And the selling costs per unit. And then sales office costs. Even though you actually have a sales office already, we could put some more in there. We're going to spend $5 million on advertising, which is crazy, but we'll do it anyway. And then you'll see that those things are also reflected into the income statement. Now we're really losing money. But you'll see that there are sales of X and sales of Y reflected in North America. And we can see that our cash flow is also affected. Okay, so that's how we can work through our sales projections. So this little workbook is useful when you're doing your initial public offering. And it's also good for planning purposes to see. You'll notice that when a plant costs $10 million, it actually needs a lot more cash than just the $10 million to keep operating. You need something called working capital or additional amounts to keep production going and that sort of thing. Okay, thank you very much and good luck.